Hi, welcome back. Rob Kaplan, founder partner at Kaplan, Vogler, Cunningham & Frank, again joined by Ray Davis, Chief Business Development Officer at Red Oak Capital Group, for the final installment in this series. We've talked a lot about the process and the integration of law firms and managing broker-dealers into the offering process, the conduct of the offering. You know, being one of the most successful issuers of these Reg A's out there, you know, I just want to take a few moments to ask about what is the long-term capital strategy for Red Oak Capital Group, and, you know, where do you see the Regulation A marketplace going, and where do you see the opportunities in the near future?
It's interesting. So the long-term capital play, Rob, is we're different than most sponsors, right? Like our offerings are designed to really reward us on the backside, right? So the goal is over the next 5 to 10 years, we've got a mixed group of ages, right? Over the next 5 to 10 years, to develop a comprehensive capital lending platform that covers everything from what the street refers to as hard money, transitional capital, all the way down to insurance, you know, what I would call LIBOR plus product, right? It's the permanent product. So the goal is to have that encompassing lending platform that's very institutional in nature, but not institutional with respect to the cost structure, that one drives the yield so low that there's no benefit to the retail investor. Because if we're bringing this full circle, we're saying this is really about the retail investor who's a stakeholder. It's really about our distribution channel who are stakeholders, and it's about the management team. Although they get paid last, they can arguably be one of the most important stakeholders as well, no matter where their profits or benefits lie. So the end goal is to say have this comprehensive lending platform that also has balance sheet stability behind it. And you don't see that in what I would call a middle market lending group. And so there's a couple things we're doing that the audience may be interested in, which is, so we're not only developing this lending platform, but we're doing things to mitigate risk through these various structures. And one of them includes rating our back-end mortgage paper, or having the ability to rate it. So why is that important? Well, it's important for a few different reasons. One, these are bond offerings, right? So what happens at the end of the bond offering if you have to liquidate and you have another COVID event or 2000 event? If your paper's rated and you're doing transactions with insurance companies, which we're now starting to do on a pro rata pari passu basis, and for the audience, that just means side by side with no priority payment. If you're doing these things, it gives you the benefit of being able to sell into a market and even create yield, not only selling for par, but being able to create yield. Again, part of that plan is having a balance sheet that also supports these activities. And if you have that, it allows you in that same situation, if you have a COVID event or 2008 event, to not only have rated paper, but have the balance sheet to take assets that may go into workout, put them on your balance sheet, and have the liberty of time where a fund may run out. So that's the long-term goal of Red Oak. And I believe we've got the team and the group to do it. And it's so far, I'm not going to say it's been without pain. Every young company has growing pains, and we have problems like everybody else. But so far, our internal controls, our external offering structure, and our investment thesis mitigating risks have all worked. And that's really all you can ask for, because if you think you're going to have an offering with no problems, you're just wrong. So if you can see all of those various things working, you're golden, right? I mean, that's what the market wants to see. They don't want to see a perfect track record. They want to see that happening. Another long-term goal for Red Oak is, you know, we're coming out with an offering. I don't know how much liberty I'm meant to talk about it because it's not out yet. But we've taken the market problems, which are the market has been compressed with a lot of groups that have brought out equity offerings. And what happens is these groups have financially engineered their offerings so they can do things to the detriment of the end investors. You know, when we are able to go into detail about that offering, Rob, we've done so many unique things within that offering to protect the investors that, again, nothing's revolutionary, right? But it's very unique to say the least. And the creativeness from our auditors, from our CFO, from your firm, is second to none on that offering, so we're excited about that. And as far as the Reg A offering, look, we're positioned to continue to grow with them. We're now coming up to the point where we can start to integrate them, and you can talk about that. We love the Reg A offerings. We don't mind all the restrictions and all the hurdles you have to jump to get over them, because we like the controls in place. I think it's an area where more companies should absolutely dig in and say, look, it's going to take more work up front, but if you do it right, the cost to raise capital is a fraction of what it is on the Reg D side, especially because you have far less marketing efforts far less marketing dollars going into the ground. So am I an advocate? Absolutely an advocate. And it's worked well for us, but it can work well for anybody who's willing to take the steps to plan. So we love them. We love them, and I'd like to see more people do them because it raises the level of diligence required to enter the market, which is only a positive thing.
And for the audience's edification, Red Oak has conducted to date 4 Regulation A offerings and have 2 in filing with the SEC currently, and has raised somewhere in the neighborhood of $200 million in the last 30 months.
And we've been, thank the Lord, we've been wildly successful. Our first one was raised in 9 months. The second was raised in 52 days. Even with COVID, the third one was raised in about 100 days, right? Like, we've been so blessed, and you'd like to think, were we lucky? Luck's always involved, but do we have a team that I'd put up against anybody, even some of the large cap folks? Absolutely. And if I had to equate our success, we've got a driven management. We've got our whole company is driven. We've got great founders. I mean, Kevin and Joe have done a great job with the company, and then Chip, obviously, just great people around. But it's people like you, it's people like Nick that kept us from making the mistakes, helping us execute on what was not the norm in respect to vision, etc. So I would be an advocate for it, not just because we're doing this series. I just think it's the intelligent way to raise capital in a very cost-effective manner, which was what the whole series is about.
Any thoughts on your part with how the Regulation A market will develop over the next 18 to 24 months depending on how COVID works out, the elections, any number of factors?
It's always easy to give an opinion, but I think there's so much uncertainty with COVID, which, look, we're a private lender, so it's been a blessing for us, and I can't help but smile because we've been blessed, but I don't wish ill will or bad luck or bad circumstances on anybody. But with the pending election and with what's happening with COVID, I just don't know, Rob. I believe at some point, especially if President Trump gets reelected, I believe that the limit should be raised, right? It seems all the motives seem to be pointing in that direction. But, my political opinion is different than most. I view opportunity no matter who's in there, right? No matter who's in the office. I tend to be a conservative, but no matter who's in the office, I think it always presents an opportunity for somebody willing to look and dig deep enough. And that's what we're going with. Yeah. Who's ever in there, we're gonna make an opportunity out of it.
I tend to agree with you. I think the market is dominated by yield products right now, which are really important when you're dealing with the volatility that we have in the publicly traded markets of late. But I do think, there are a couple of potential exchanges that are being proposed to the Securities and Exchange Commission right now. And I think to the extent that we can provide not equivalent liquidity to the public markets, but enhanced liquidity over what we have now, I tend to agree with you. I think the Reg A market will be able to adjust to whatever political or economic circumstances are going on, much like the traded markets do, and it's merely a question of finding the opportunities.
Absolutely. The liquidity feature is really important. A lot of people discount it and they say, well, some products are illiquid. And I would disagree with that. We have a couple products that would be considered illiquid, and we found a way through creativity to make some semi-liquid, to make some fully liquid, with, of course, run on the bank provisions. But we've found a way, and there's organizations that will provide liquidity. No different than selling a stock in a down market or, at the beginning of a crisis situation, you're going to take a haircut. These liquidity provisions provide for people who have no choice but to exercise and take that liquidity. And it may be not the most ideal situation, but it can be done within the Reg A market. And so I would just encourage people to say, look, it's important, and if it can be accretive to some folks when it does happen, but it's also a great feature for the investors and for your distribution channel.
Yeah. Well, it's been a real pleasure to do this series. The information does not end with the conclusion of this series. We will continue the blog associated with this site. There will be a lot of information, a lot of good questions, and hopefully good answers coming out of that from
That's right.
myself, Ray, and Nick Dern at Crescent Securities. And we encourage you to contribute to the dialogue there. Thanks so much for joining us.
Thank you.